Did you know that over half of investors lose money not because of the markets, but because of common investment traps? Today, I'm breaking down the top traps that could be holding you back from financial freedom. Welcome back, everyone. Today, we're talking about something that impacts almost every investor at some point: investment traps. These are the pitfalls that sneak up on you, tempting you with quick gains or promising opportunities, but ultimately leading to financial setbacks. In this video, we'll dive deep into these traps and, more importantly, how to avoid them. Because if financial freedom is your goal, you'll want to steer clear of these costly mistakes. Investing isn't just about picking the right stocks or funds. It's about making strategic decisions and avoiding the traps that can derail your progress. Let's talk about a few of these challenges. Common misconceptions. Many people believe that investing is all about quick profits or that luck plays a major role in success. This misconception often leads to impulsive decisions rather than informed choices. Psychological traps. The psychological aspect of investing is huge. Traps like the fear of missing out, FOMO, overconfidence, and impatience lead to emotional decisions rather than logical ones. We see investors jumping in and out of markets based on trends instead of long-term plans. The problem of lack of strategy. Without a clear plan, many investors end up chasing returns, buying high and selling low. They're reactive, not proactive, and this keeps them in a cycle of buying on hype and selling out of fear. Each of these traps can limit financial growth, and without awareness, it's easy to fall victim. But recognizing these challenges is the first step to overcoming them. All right, let's break down the most common traps that investors face, and I'll explain each with examples to help you avoid them. Chasing trends. This is one of the biggest traps out there. Investors see a hot stock or sector rising quickly and jump in without research. We've all seen it: the hype around cryptocurrencies, tech stocks, and other trending investments. People jump in after prices have already soared, and by the time they buy, it's often too late. Example: many people bought into cryptocurrency at the height of the 2017 or 2021 peaks, only to experience huge losses when the prices corrected. Emotional investing. Investing based on emotions like fear or excitement rather than data is a major pitfall. During market downturns, panic often sets in, causing people to sell low. Conversely, during bull markets, FOMO leads to buying at high prices. For instance, the fear during market drops in 2008 and 2020 led to panic selling when prices were at their lowest, missing the recovery that followed. Neglecting research. Many people invest in something just because a friend or an influencer recommends it. But without proper research, it's easy to invest in something that isn't aligned with your goals or risk tolerance. Example: buying a stock or fund because it's trending on social media, but not understanding the company behind it or its long-term prospects. Over-diversification. While diversification is essential, too much diversification can spread your investments too thin, diluting potential returns. If you're invested in too many different funds or stocks, it can become nearly impossible to track each one, and your portfolio might just mimic the broader market with no real benefit. Ignoring fees and costs. Fees can add up over time and eat into your returns, especially with frequent trading or high-fee funds. Overlooking these costs is a common trap that reduces long-term growth. For example, a fund with a 2% fee may not seem like much, but over 20 to 30 years, that fee significantly impacts your investment gains. Being aware of these traps isn't just about avoiding losses. It's about making smarter, more informed decisions that set you on the path to financial freedom. Now, here's the game changer. Simply being aware of these traps and educating yourself can drastically improve your investment results. Knowledge is powerful in investing. When you understand these traps, you can recognize them early and avoid making costly mistakes. For me, the real turning point came when I took the time to understand the psychology behind investing and began educating myself. By learning to control my emotions and making data-driven decisions, I started seeing consistent progress. This awareness transformed my approach from reactive to proactive, and that's what made all the difference. So, let's recap. Avoiding investment traps is all about awareness, education, and discipline. Don't chase trends or make decisions based on emotions. Always do your research, understand what you're investing in, and keep fees in mind. By steering clear of these traps, you set yourself up for smarter, more stable growth. Remember, the journey to financial freedom is about steady progress and making informed choices. If you've fallen into any of these traps or have questions about avoiding them, let's chat in the comments. And don't forget to check out my other videos on investment strategies and financial growth. Make sure to subscribe, hit the notification bell, and join me on the journey to financial freedom.